Hey, folks, this is the next installment of Planning for High Earners. Today, we're going to talk about insurance, a topic that virtually nobody wants to discuss. Most of us need it, few of us want it. My postulation on this is insurance forces us to think about unpleasant things, death, disability, and disaster. It's emotionally hard to spend time on. At the same time, if you need it, you will wish that you'd thought through it and that you own the appropriate coverages. That makes it an important part of your financial planning, so we're going to discuss it. What kind of things do we insure? Well, the cost of healthcare, loss of income, and destruction or loss of property are the things we insure the most often. Why do you buy it? Well, you buy it to lower your cost of healthcare and reduce or eliminate the risk of very large, back-busting expenditures. You buy it to reduce or eliminate the risk and impact of loss of your earned income, and you buy it for the same reasons to protect your property, to reduce the impact of loss or significant damage or cost. Most people who are high earners have some thoughts about whether they can self-insure, particularly if they've accumulated a lot of capital or net worth. Sure, you can. However, if you don't have the dollars to cover the cost of a risk or loss, what you're actually doing is carrying the risk. That's not self-insuring. What you're doing is making a bet that that loss will not happen to you. Now, is insurance the best use of your dollars? Financially, if you never incur a loss, no, it is not. The problem is we cannot know this in advance. All we can know are the probabilities. And the funny thing about probabilities is that people believe low probability items will not happen and higher probability items are certain. Neither one of these is true. This is the brain fooling you. I've come to the conclusion over the last 20 years or so that probability is one of the least understood and probably most important areas of math. I mean, if you think about it, a 1/10 of 1% probability is going to happen to about 38,000 people in our population of 380 million. And a 5% probability, which feels awfully low and one of those things that, quote, won't happen to me, unquote, is going to hit 19 million people. And we have no way of telling if one of those people is going to be you. So the question then becomes, can you afford a loss? That is, it wouldn't be a material setback if it occurs. If the answer to that is no, then I think you should be buying insurance. I'm going to start with life insurance since it gets the most attention. I'll cover disability and perhaps long-term care insurance maybe next week. We just don't have enough time in the day and there's too much complexity to cover them all in one swoop. You'd own it because somebody would need your income if you're not here. Or maybe you want to leave money behind for someone or something, or perhaps there will be estate taxes due and you'd rather not liquidate assets out of the estate to pay the taxes. It also might be more efficient to actually pay the insurance premium and let the insurance pay the taxes. That's a long conversation, but all of these are good reasons to engage in financial planning. And of course, there are lots of variations on these, but these to me are the basics. Now, there are two ways to own life insurance: term insurance and permanent insurance. Term insurance is just that. You own it for a fixed term. It's very simple. It's generally very low cost and easy to understand. Now, there are products that allow for renewal, typically at a much higher premium. The risk you have with term insurance, whether you own it for 10 years or 30 years or more, is that you still need some insurance when the term is up. You are going to see a cost increase then, and you might not be able to even buy it. It all depends on what your health and age are at the time. Chances are typically pretty good that you will not die during the term, so the premiums tend to be low, which makes it very affordable. And most younger people buy almost exclusively term insurance. The critical factor here is to buy it from a company that's financially sound enough so that if you die during the term, they can pay the death benefit. Permanent insurance is just that. It's permanent. It's there when you die, not if you die, presuming you pay the premiums to keep it in force. The company knows what you know, plus a little bit more. They know you're going to die, and they know they're going to pay the death benefit. assuming you keep the product in force, and a lot of people cancel these contracts. The only question is when. And that's why they do a lot of actuarial work. Permanent insurance products are priced accordingly because they know they're going to pay a death benefit. You can expect to pay 10 or maybe 20 times as much in premium, sometimes a little less, sometimes a little more. There are a number of factors here. You also have a lot of options. Do you build up cash value in the product or do you not? Do you want to pay premiums for a fixed period of years? Could be maybe as little as 7 or 8 or as long as lifetime. You can also do a single premium. You can buy a blend of term and permanent insurance, and sometimes there's term insurance that automatically converts to permanent insurance. You can buy index fixed or variable contracts. The point here is that this can be and often is a complex product. It warrants, in my opinion, detailed analysis prior to purchase. Most of the time, owning it for less than 10 to 15 years usually turns out to be pretty costly. There are good reasons to own permanent insurance, and it can be both cost-effective and a good solution when structured properly. My experience is it is often missold. Part of the reason there is that insurance agents are typically paid on a commission based on the structure of the contract and the premium. So higher premiums mean more commission, and there's a large incentive to sell permanent insurance over term. My other experience is many permanent insurance contracts are canceled, and when they're canceled in the first 10 to 15 years, it's usually not a good use of your money. All in all, it still means that you need to do the analysis and do the planning and figure out how much life insurance you need and over what period, knowing that there are a lot of unknowns. I hope this is useful. If you have questions or there's something you need me to cover, please let me know. I hope you have a fabulous week and a wonderful day. Bye-bye.